Thank you for tuning in to LeadDeveloper.com, where we simplify complex property development feasibilities, investment analysis, and everything real estate. Whether you're a seasoned pro or just starting out, our Google Sheets-based feasibility suite streamlines the toughest aspects of real estate. Lead Developer Feasibility Suite is trusted by thousands in over 17 countries. Our tools cover everything from quick assessments to detailed cash flow projections and more. Sign up today at LeadDeveloper.com for unlimited free access to our expanding library of real estate tools. No credit card needed. Plus, get full support through Edge with step-by-step guidance, exclusive courses, and resources designed for your success. Turn numbers into narratives that win over investors and lenders. Join Lead Developer now.
Welcome back to the Deep Dive. Today, we're going to try to tackle something that, well, it sounds pretty complex at first, but it's really a super useful tool that any real estate investor can use, and that's discounted cash flow analysis.
Yeah.
You want to get savvy with DCF?
Absolutely.
So you can evaluate those potential investments and make smart decisions, right?
Exactly. And I think a lot of people, when they first hear discounted cash flow, they get intimidated.
Yeah.
But it really is just a way to look into the future of an investment.
Oh, okay.
Almost like a financial time machine, you know?
Okay, I'm already liking this. So instead of just looking at the price tag today,
Right.
DCS lets us peek into the future and see what the property could earn, right?
Exactly. And I think that's the key takeaway here, is that it helps you understand what a dollar earned from that property in the future
Okay.
is worth in today's money.
Right, because a dollar today is worth more than a dollar tomorrow. And I could invest that dollar now and it could grow. But how do we actually travel through time with this financial time machine?
Right.
What's the formula?
So the formula itself can seem a bit technical.
Yeah.
But the core concept is really all about discounting those future cash flows back to their present value using a specific discount rate.
Discount rate. Okay. That's a term that I've come across
Yeah.
before. Is that where things like inflation and risk come into play?
You got it. So the discount rate represents the return that an investor like yourself would expect based on the risk associated with a specific investment.
Okay.
So the riskier the investment,
Okay.
the higher that discount rate.
Okay.
And you're absolutely right. Inflation is baked into that calculation as well.
That makes sense. So riskier investments need a higher discount rate. It's kind of like you're demanding a higher reward for taking on more uncertainty.
Precisely. And, you know, in the materials that you share, you had highlighted some Excel formulas for them. So, you know, this isn't just theory. This is something you can actually crunch the numbers on.
I like it. Yeah.
Yeah.
I like that it's something that I can use Excel for. So it's not so intimidating after all.
Exactly.
Okay. So we've got this discount rate.
Right.
But what else makes this DCF engine run?
Well, think of DCF like a three-legged stool.
Okay.
You need all three legs for it to stand strong.
Okay.
We've got one leg, the discount rate.
Okay.
The other two legs are free cash flow
Okay.
and terminal value.
Okay. Three-legged stool. I like that. So what's free cash flow all about?
Free cash flow is the actual cash that the property generates
Okay.
after covering all of its operating expenses.
Okay.
So this is the money that is available to both debt and equity holders.
Okay.
It's not just profit on paper,
Right.
but it's the cold, hard cash that you could potentially put in your pocket.
Got it. It's like the heartbeat of the investment, the
Yeah.
actual cash bumping through the property.
Right.
Okay. And what about this terminal value leg? It sounds like a sci-fi term.
Yeah, it might sound futuristic, but really it's just the property's value
Yeah.
at the end of our analysis period.
Okay.
So think of it like an estimated sale price down the line.
Right.
We're not just looking at a few years of cash flow, but we're also considering what that property might be worth
Okay.
when you decide to sell it.
So it's kind of like we fast forward to the end of the movie
Yeah.
and see how everything wraps up.
Exactly.
But how do we predict what a property will be worth years down the line?
So there are two main methods.
Okay.
The first is called the multiplier method,
Okay.
which uses a multiple of the property's net operating income in the final year.
Okay.
And then the other one is called the perpetuity growth method,
Okay.
which assumes that the property's cash flow will grow at a steady rate forever.
Wow, forever. So we've got our three legs: discount rate, free cash flow, and terminal value.
Right.
But how do we actually apply all of this to a real-life property? Walk me through it.
Okay, so let's imagine you're considering investing in a rental property.
Mm-hmm.
The first step is to project the cash flow.
Okay.
So we need to estimate all the cash that the property will generate
Oh,
and spend over its lifetime. Right. So think rent, expenses, and even that potential sale price way down the road.
So it's like we're creating a financial forecast
Exactly.
for the property's life.
Yeah.
But that seems like it could get pretty complicated.
It does require careful research and realistic assumptions.
Okay.
You don't want to get overly optimistic about things.
Right.
But there are, resources and tools out there that can help you through this process.
Okay, that's reassuring. So we've got our projected cash flows.
Right.
What's next?
Next, we need to determine that appropriate discount rate.
Okay.
Remember, this reflects the risk associated with that specific property and the overall market.
Okay.
So think about things like interest rates, how similar investments are performing, even the track record of the company that's managing the property.
So if interest rates are high, the discount rate would go up.
Exactly.
And if the property is in a booming area, maybe the discount rate would go down.
You're getting it. It's almost like you're adjusting the lens of our financial time machine to get a clearer view of the future.
I like that. And also don't forget, in the materials you sent over, you had highlighted 6 aspects of discount rates.
Right.
That fluctuate over time and impact that final valuation.
Okay.
We'll dive deeper into those later.
6 aspects. Wow. Okay, so we've got our projected cash flows,
right?
Our discount rate. What about that final leg of the stool, terminal value? How do we bring that into the picture?
So imagine you decide to sell that rental property years from now. The terminal value helps us estimate what you could get for it.
Okay.
Like the grand finale of our cash flow projection.
Okay, so we're not just focusing on the year-to-year income.
But we're also thinking about that potential final payday.
Exactly. And as we mentioned before, there's different ways to calculate that terminal value.
Okay.
Depending on factors like expected growth and market conditions.
Okay. This is making a lot more sense now. It feels less like a magic trick.
Yeah.
And more like a powerful tool I can actually use.
That's exactly what it is. And the beauty of DCF is that you can do it all using simple spreadsheets.
Okay.
Like Excel. It's not just for Wall Street analysts.
Right.
It's for anyone who wants to make more informed real estate decisions.
I'm loving this. We've got our 3 legs of the stool. We've got our Excel spreadsheets fired up. It's all starting to click into place.
Yeah.
But why is DCF so powerful specifically for real estate investors?
Right.
What are the key benefits?
Great question. I think one of the biggest advantages is that DCF forces you to consider the time value of money, risk, and cash flow, which are arguably the 3 pillars of any smart investment decision.
So it sounds like DCF really helps you cut through the noise and focus on the real financial heartbeat of the property.
Exactly. And another big plus is that DCF is an industry standard.
Okay.
So many real estate professionals use it.
Okay.
So understanding DCF allows you to speak their language
Okay.
and evaluate deals on the same playing field.
So I'm not just learning a fancy formula. I'm learning how to think like a pro.
Exactly.
And we already talked about how accessible DCF is.
Right.
Thanks to tools like Excel.
Absolutely. It's a powerful tool that's within reach for anyone who wants to level up their real estate game.
This is all incredibly insightful, but before we get too carried away, I do want to talk about something you mentioned earlier, common pitfalls.
Right.
Even experts can make mistakes.
Absolutely.
Right. What are some traps to watch out for when using DCF?
You're right to be cautious. Even with the powerful tool like DCF, there's still, things to watch out for. I think one common mistake is using an unrealistic discount rate.
Okay.
So either being overly optimistic or, being too conservative.
So either underestimating the risk and potentially overpaying or demanding such a high return that you miss out on good opportunities.
Exactly. It's a balancing act.
Okay.
Another common mistake is being overly optimistic about future cash flow projections.
Right. Like assuming rents will always go up.
Right.
Or that there will never be any unexpected expenses.
Precisely. It's important to be realistic and factor in potential fluctuations in the market.
Right.
And I think finally, a lot of investors forget to include all of the costs associated with a real estate investment.
Yeah, I bet things like acquisition costs, holding costs, and even selling costs can really add up.
Absolutely. You need to account for every single cost
Okay.
throughout that entire investment life cycle
Okay.
to get an accurate picture.
This has been fantastic. We've covered a lot of ground.
Yeah.
But don't go anywhere. We'll be back in a moment to continue our DCF deep dive
Okay.
in part 2.
Sounds good. Welcome back. I'm excited to dive even deeper into DCF with you.
I'm ready. That first part really demystified a lot of the jargon, but I have to admit, the discount rate still feels a bit like a puzzle to me.
Yeah.
There are so many factors to consider.
You're right. It's not as simple as just picking a random percentage.
Right.
And remember that the discount rate reflects the required rate of return for an investor like you. And to figure that out, we need to put on our detective hats.
Ooh, I like a good financial mystery.
Yep.
So what are we investigating?
Well, in the materials that you sent over, you highlighted 6 aspects of discount rates. They change over time. They're impacted by the market. They depend on what's being discounted.
Right.
They must be risk-adjusted. They're calculated using various investment yields.
Right.
And they're adjusted for inflation.
Okay, 6 clues. That's a lot to unpack. Let's break them down one by one.
Absolutely. So we can start by thinking about the discount rate like a recipe.
Okay.
It has external ingredients, those big picture factors, and internal ingredients, those specific to the property and the company managing it.
Okay, so external ingredients are kind of like the market conditions.
Exactly. Things like the overall health of the economy, how interest rates are trending, and even how other investment options are performing.
Right.
You know, those all set the stage.
Makes sense. If everyone's making a killing in the stock market, you'd probably demand a higher return from a real estate investment. Right?
Precisely. It's all about opportunity cost.
Okay.
Now, let's add in our internal ingredients. Things like the financial risk of the specific property and the company that manages it.
Okay, so if the company has a strong track record and the property is in a desirable location, that would reduce the risk.
You got it. And on the flip side, a company with a shaky financial history or a property in a declining area, that would increase the risk.
It's like using expired ingredients.
Exactly.
Not something you want in your investment recipe.
Exactly.
Okay, so we're gathering all these ingredients, both external and internal, to determine the appropriate level of risk. But how do we actually cook up that final discount rate?
So there are a few approaches, but one common method is what's called the capital asset pricing model, or KEAPM.
KEAPM.
Think of it like our trusty recipe book.
What's the recipe look like?
So KEAPM breaks the discount rate down into 3 main components. It starts with what's called the risk-free rate, which is like the basic flour in our recipe. So it's the minimum return that you would expect, even without taking on any risk.
And I imagine that risk-free rate is usually based on something like a U.S. Treasury bond.
Exactly.
Super safe and stable.
Exactly.
Next,
we add in what's called a general risk premium, which accounts for the risk of investing in real estate compared to that super safe bond. It's like adding some spice to our dish, acknowledging that real estate comes with a bit more uncertainty.
Okay, so the risk premium bumps up the return we'd expect to compensate for that added uncertainty.
Exactly.
What's the final ingredient?
The final component is the company-specific risk factor. This is where we really zoom in on the players involved. Think of it like checking someone's references before you hire them. So we look at the company's track record, their experience, any red flags.
So a company that consistently delivers strong returns and has a stellar reputation. That's like finding a contractor who comes highly recommended, glowing reviews.
Less risk, more peace of mind.
Less risk, more peace of mind.
Exactly. And that peace of mind translates into a lower discount rate. We're essentially saying we trust these guys. So we don't need as high of a return to compensate for potential risks.
This is making so much more sense. It's like we're building a multi-layered cake, starting with that basic risk-free layer, and then adding in layers of risk premium and company-specific factors.
I love that analogy. And just like with a cake, getting those layers right is crucial for a successful outcome. Even a small change in the discount rate can have a significant impact on that final valuation.
So we need to be precise with our measurements and make sure we're not using too much or too little of any ingredient.
Exactly.
Now that we've really broken down the discount rate, let's revisit that other fascinating component of DCF, terminal value. You mentioned there are 2 main methods for calculating it. Can you walk me through those?
Of course. So remember, the terminal value represents the property's value at the end of our analysis period, that grand finale that we talked about earlier. So the first method, the multiplier method, is kind of like using a magnifying glass to project that future value.
Tell me more.
We take the property's net operating income in the final year of our analysis and multiply it by a predetermined factor.
Okay.
That factor is based on market data and comparable property sales.
Okay.
So kind of like looking at what similar properties are selling for in the current market.
So if we expect the property to be generating, let's say, $100,000 in net operating income in that final year,
Yeah.
and the market suggests a multiplier of 10, the terminal value would be $1 million.
We got it. So it's a simplified way to estimate that future selling price.
Okay.
Now, the second method, the perpetuity growth method, is a bit more complex.
Perpetuity growth, that sounds intense. Is this where we need our financial time machine to really kick into gear?
You could say that. So this method assumes that the property's cash flow will continue to grow at a constant rate forever.
Forever, like a never-ending fountain of cash.
Exactly. So we use a formula
Okay.
to calculate the present value of that infinite stream of cash flows, which gives us the terminal value.
Wow. So we're not just projecting for 5 or 10 years, we're looking into perpetuity.
Exactly.
But both methods sound interesting. Which one is better?
That's the million-dollar question, and unfortunately, there's no one-size-fits-all answer.
Right.
The best method really depends on the specific circumstances of the investment.
So it's back to being a financial detective.
Precisely. So if you have reason to believe that the property's cash flow will grow at a stable rate for the foreseeable future, the perpetuity growth method might be more appropriate.
Okay.
But if you're not confident in making those long-term growth assumptions, the multiplier method might be a safer bet.
It seems like choosing the right method is really crucial for an accurate valuation.
Absolutely.
Are there any other challenges or special considerations when applying DCF specifically to real estate, as opposed to other types of investments?
That's a great question. So one key difference is that real estate is a tangible asset, which means that it's subject to physical deterioration and obsolescence.
Right.
Unlike a stock, a building can literally crumble over time.
Right. So we need to factor in things like maintenance and repair.
Exactly.
Even potential renovations down the line.
Exactly.
I hadn't really thought about that.
Yeah, those costs need to be baked into our cash flow projections.
Okay.
And another crucial factor is location.
Right.
Arguably even more important in real estate than in other investments.
Absolutely. Location, location, location. Right.
Exactly.
A property in a thriving area with strong demand is going to behave very differently than one in a declining market.
Precisely. So when applying DCF to real estate, it's crucial to thoroughly research the local market.
Okay.
Consider demographics, job growth, access to amenities, and even things like zoning changes or upcoming developments.
It seems like applying DCF to real estate requires a deep understanding of both financial concepts and real estate fundamentals.
You're spot on. It's a blend of art and science. But with practice and a willingness to learn, you can become proficient in using DCF to make those smarter real estate decisions.
This has been incredibly enlightening. We've covered so much ground already.
Yeah.
But there's still more to explore.
Stay tuned as we wrap up our DCF journey in part 3.
Welcome back to the Deep Dive. We've spent the last 2 parts really getting into the nitty-gritty of discounted cash flow.
Yeah.
And I have to say, I'm feeling a lot more confident about using it to evaluate real estate investments.
Oh, it's great to hear.
You know, I've covered the formulas, the calculations, all that technical stuff.
Right.
But I'm curious, what are some of the less obvious benefits of using DCF? How does it change the way you think about real estate investing as a whole?
That's a great question. And I think one of the most valuable but often overlooked benefits of DCF is that it forces you to think long-term. Instead of getting caught up in that initial purchase price or the first year's potential rental income, you're forced to project those cash flows over an extended period, sometimes even decades.
It's like you're zooming out and looking at the whole lifespan of the investment.
Exactly.
Not just a snapshot in time.
Right. And that long-term perspective can be a real game changer.
Okay.
It might reveal that a property that seems expensive up front could actually be a fantastic investment over time because of its potential for appreciation or rental income growth.
So it helps you see beyond those initial numbers and really evaluate the true potential of an investment over the long haul. It's almost like having a crystal ball that shows you the property's future.
I love that analogy. And that long-term perspective can also help you avoid those impulsive decisions.
Right.
You know, it encourages you to be more disciplined and patient in your approach to real estate investing, which is crucial in a market that can be driven by emotions and hype.
Oh, absolutely. It's so easy to get caught up in the excitement of a hot market. But DCF helps you stay grounded in the numbers and make those rational, data-driven decisions.
It's like having a financial compass to guide you through those ups and downs.
I like that. Another less tangible benefit of DCF, I think, is that it helps you pinpoint the key drivers of value for a specific property.
Absolutely.
What do you mean by that?
So by breaking down those cash flow projections and analyzing each component, you start to understand what factors are most influential in determining that property's overall value. Is it rental income growth? Expense control? The potential for future appreciation? DCF shines a spotlight on those key levers.
So it's not just about arriving at a final valuation number, but it's about understanding the story behind that number.
Exactly.
What's really driving it.
And that deeper understanding empowers you to make smarter decisions across the board. Whether it's negotiating a purchase price, deciding on a renovation strategy, or even setting rental rates.
This is all making so much sense. DCF is more than just a formula. It's a framework for thinking about real estate investments in a holistic and strategic way.
I couldn't agree more.
Yeah.
It's a way of thinking, a lens through which you can view opportunities and make those informed decisions with more clarity and confidence.
This has been such an incredible deep dive into DCF.
Yeah, it has.
We've covered so much ground, but before we wrap up, I want to touch on one last thing. We've talked about all the amazing benefits of DCF. But are there any limitations? Are there situations where it might not be the best tool to use?
That's a fantastic question, and it's important to remember that no tool is perfect, even one as powerful as DCF. I think one of the biggest limitations of DCF is that it relies heavily on assumptions about future cash flows, which, as we all know, can be unpredictable.
We're making educated guesses about things like rental income, expenses, even future market conditions. But there's always a chance that things could go differently than we expect.
Exactly. And those assumptions can have a significant impact on that final valuation number. That's why it's so crucial to be realistic with your projections and consider a range of possible scenarios, both good and bad.
So sensitivity analysis is key.
Exactly.
Playing around with those assumptions and seeing how it impacts the outcome.
Absolutely. And another limitation of DCF is that it doesn't always capture those intangible qualitative factors that can influence a property's value. So things like the overall quality of the neighborhood, the curb appeal of the property itself, or even the reputation of the property management company.
Those are all important factors, but they can be hard to quantify and plug into a spreadsheet.
Exactly. So while DCF is an incredibly powerful tool, it should be used in conjunction with other forms of analysis and due diligence. Don't rely on it alone.
Great advice. It's all about using the right tools for the job and understanding their strengths and limitations.
Absolutely.
This has been such an eye-opening journey into the world of discounted cash flow. We've covered the technical aspects, the intangible benefits, even those important limitations to keep in mind.
Absolutely.
Well, I hope you feel empowered to start using DCF to evaluate real estate investments and make those decisions with more confidence and clarity.
I hope so too.
And for our listeners, remember, this is just the beginning of your DCF journey. There are so many resources available to help you dive deeper.
Exactly.
So don't be afraid to keep learning and experimenting.
Real estate investing is all about finding those opportunities that align with your individual goals and your risk tolerance. DCF can help you navigate those choices and make decisions that are right for you.
Wonderful. Well, thank you so much for sharing your expertise with us today.
Of course. Happy to be here.
It's been an absolute pleasure having you on the Deep Dive.
It's been a pleasure being here.
And to our listeners, thank you for joining us on this deep dive into the world of discounted cash flow. We'll see you next time for another fascinating exploration of a topic that matters to you.